Your credit app shows a 740. The mortgage officer pulls a 670. Neither is lying. You're checking a free VantageScore, but lenders buy older FICO models. Here's how to fix the gap. That 70-point swing isn't a rounding error. On a mortgage, it's tens of thousands of dollars over the life of the loan. At a car dealership, it's 0% financing versus 7%. And most people never learn which score their lender actually used until they're signing the papers. This is optimized credit, where we teach how credit actually works. Here is the core truth. The score you see depends on three moving parts at once: the scoring family, the version of the score, and the bureau data being used. Change one of those and the number can move. Change two or three and the gap can get big fast. That is exactly why someone can look at a healthy score in an app in the morning and hear a much worse number from a lender that same day. The biggest split starts with FICO versus VantageScore. At a high level, both are trying to do the same thing. They are both trying to predict lending risk using data from your credit report, but they do not weigh that data the same way. They react differently to the same file. That is why the numbers do not always line up. Most consumer apps show some version of VantageScore. Most lenders use some version of FICO, and that alone creates confusion. But it gets deeper than that. Lenders are not all using the same FICO either. Mortgage lenders often use older classic FICO mortgage versions. Auto lenders may use auto-specific versions. Credit card lenders may use something different again. So now you have one scoring family on your app and the completely different scoring family at the lender. That is why app scores can be useful and still be the wrong number for the decision you actually care about. Thin files make this even worse. If your credit file is newer or lighter, one scoring system may generate a score before another one does. So you can look at an app, see what feels like a healthy number, and assume you are ready. Then the lender pulls a different model and either gets a much weaker score or not enough usable history at all. That is where people get blindsided. And the scoring family is only one piece of it. The bureau matters too. You do not have one credit file. You have three: one at Equifax, one at Experian, and one at TransUnion. They overlap, but they are not identical. Not every creditor reports to all three. A balance may update on one before the others. A collection may show on one bureau but not the rest. If you want a free, personalized 30-day action plan built from your actual credit report, head to optimizecredit.net. Now, let's keep going. So even if the model stayed the same, the underlying data can still change depending on which bureau gets pulled. Different input, different output. That is why saying my FICO score is not really precise enough. At the very least, you usually have multiple bureau-specific versions before you even get into model differences. And then there is timing. Credit data is not live. Your balances do not update every minute. Most issuers report roughly once a month. So if you pay a balance down today, your score may not reflect that right away. If you check your app on Monday and the lender pulls your file on Friday, the underlying report may not be identical anymore. That is how people end up with score shock. Now let's talk about trended data, because this is where things get more serious. Older models are more like snapshots. They look at what your balances look like right now.
Newer trended data models look at how you have behaved over time. In simple terms, they're asking a bigger question. Do you usually pay in full, or do you usually carry balances month after month? That matters because last-minute fixes do not always work the same way anymore. Under an older snapshot model, paying cards down right before an application can make you look a lot stronger immediately. Under a trended data model, the algorithm may still see that for the last year, you were regularly revolving debt, so a dramatic payoff right before the application can still help, but it may not erase the story your pattern has been telling. That is why long-term healthy behavior beats last-minute scrambling. Here is the practical takeaway. The only score that really matters is the one your specific lender uses for your specific goal. If you're buying a house, you need to care about mortgage scores. If you're financing a car, you need to care about the score model tied to auto lending. If you're applying for a credit card, the bank may be using a different version again. So use your free apps for trend monitoring. They are good for that. They can show you whether things are generally moving in the right direction, but do not treat them like a guaranteed preview of what a lender will see. Before any major application, pull all 3 reports. Ask the lender which score family and version they use, and make sure you are optimizing for the score that actually matters for that lending decision. Because when real money is on the line, the easiest score to see is rarely the one that matters most.
Understanding these foundational rules is only step 1. To map out your exact next moves, run a free profile scan and get your 30-day action plan at optimizecredit.net. And make sure to subscribe for more step-by-step credit education.